Okay, I have to be honest. I spent a good chunk of my morning routine just feeling like I was taking crazy pills. I'm sitting there with my coffee, scrolling through the financial feeds, and I just hit this wall of absolute doom and gloom about Japan. I was reading this market commentary from Forbes, and the picture it paints is, well, it's ugly. You've got the yen just cratering to historic lows. Government bond yields are spiking, and the central bank they look completely cornered. It honestly reads like an obituary for a G7 economy.
Sounds like a system on the verge of cardiac arrest. Usually when you see those signals, currency collapse, rising yields, it's the precursor to a very, very bad time.
Exactly. It felt like I was reading about a disaster movie, but then, and this is where the crazy pills come in, I switch tabs, and what do I see? Warren Buffett, Berkshire Hathaway. They are not running for the exits. They are not panic selling. They are doubling down. They're issuing yen bonds, buying up Japanese trading houses, and they're basically doing a victory lap. So here's my central question, and it's really the mission for this deep dive. How is it physically possible for a country to be a crisis zone and a gold mine at the exact same moment? I mean, is one of these narratives just lying to me?
That is the question, isn't it? And honestly, that feeling of being gaslit by the news, that is a very common side effect of modern financial reporting. But to answer you directly, no. Neither of them is lying. They're both telling the absolute truth. But they are describing two completely different layers of reality.
Okay, but they can't both be right about the direction of the country. I mean, one says the elevator's going down to the basement and the other says it's going up to the penthouse.
Well, they can be. If you stop looking at the economy as like a 2D photograph. What we're going to do today is apply a specific framework from our research notes called ECP-5. It suggests that we need to treat this news event, the Japan situation, not as a story to be judged, but as a beam of white light. To understand why it looks like doom to Forbes and boom to Buffett, we have to run it through a prism. We have to split the light.
I love that image. Economic spectroscopy. So before we start splitting light, we need to agree on the source beam. What is the raw data that generated these two conflicting stories? Like, what actually happened this week?
Let's start with the crisis signal, the one you saw in that Forbes piece. It really boils down to three flashing red lights. First, and this is the technical one, you have the JGB's Japanese government bonds. The yields on the 10-year and 30-year bonds they're rising rapidly.
And just for anyone listening who might not trade bonds daily, can we do a quick refresher? When yields go up, that's bad for the issuer, right?
Right. Think of it this way. Bond prices and yields move in opposite directions. So if yields are spiking, it means the market is selling off the bonds. It means investors are demanding a higher return to hold Japanese debt. And for the issuer, the Japanese government, it means their cost of borrowing is skyrocketing.
Yeah.
For a country with Japan's level of debt, which is massive, over 250% of their GDP, that is a suffocating amount of pressure on the national budget.
Okay, so red light number one, the government's credit card bill just got way, way more expensive.
Exactly. Red light number two, the yen. It has been historically weak against the dollar. We're talking levels we haven't seen in decades. And red light number three is just the general vibe volatility. The market just feels fragile. So if you're a central banker, a politician, or just a regular citizen, this looks like a crisis.
Okay, so that's the scary movie. Now, what movie is Warren Buffett watching? Because clearly he's eating popcorn and enjoying the show.
He's watching a heist movie, a very successful, very sophisticated heist movie. While the bond market is panicking, Berkshire Hathaway has been heavily investing in 5 specific companies called Sogo Shosha.
Sogo Shosha, I've seen this term. These are the big trading houses, right? Like Mitsubishi, Itochu, Mitsui.
Correct. These are giants. And these investments aren't just doing okay.
Yeah.
They're printing money. The stock prices have surged, the dividends are fat, and Buffett's unrealized gains are in the billions. He's looking at this same Japan and seeing the best trade of the decade.
Okay, so this brings me back to the mechanic.
Mm-hmm.
How is he making money in a burning building? Is he shorting the country? Is he betting on the collapse?
No, and that's the beauty of it. He isn't betting against Japan. He's arguably long on Japan, but in a very specific structural way. The source material outlines this as a classic carry trade structure, but applied corporately. Here's the cheat code, if you want to call it that. Buffett didn't take billions of US dollars from his bank account, convert them to yen, and then buy these stocks.
He didn't. I just assumed that's how international investing worked.
Usually, yes. But here he got clever. He issued debt in Japan. Berkshire Hathaway sold bonds denominated in yen. Because interest rates in Japan have been near zero for years, while rates in the US were climbing, he borrowed that money for peanuts. Let's say he's paying, Hypothetically, what, maybe 0.5% or 1% interest on that debt.
Okay, so he has a massive pile of almost free cash.
Exactly. He takes that cheap cash and buys stocks in these Sogo Shosha. Now, these trading houses are mature, cash-rich giants. They pay dividends of, say, 4%, 5%, sometimes nearly 6% if you count buybacks.
I see the math. I pay 1% to the bank to borrow the money, and the stock pays me 5% just for holding it. I pocket the 4% spread.
You sit in the middle and you collect the difference. It's pure arbitrage. And here's the kicker. Because he borrowed in yen and bought assets priced in yen, he neutralized a huge chunk of the currency risk. If the yen crashes, which it did, the value of his assets might look lower in dollars, but the debt he owes also gets cheaper to pay back. They sort of cancel each other out structurally.
It's elegant. It's almost annoying how elegant it is. But this is where I get stuck. Usually when we hear weak currency and rising rates, we are trained to think economic failure. We think of emerging markets collapsing. Why isn't that logic applying here? Why isn't the crisis canceling out the profit?
This is the pivot point.
Yeah.
This is the moment we have to abandon our usual good economy versus bad economy mindset. The notes refer to this as the observation position.
Mhm.
We have to stop asking, is the economy good? And start asking, who is standing where? The framework here is structure over impression.
Structure over impression. I like that. Unpack that for me.
Well, most of us read the news to get an impression. Is the vibe happy or sad? Is it safe or dangerous? But sophisticated players like Buffett are looking at the structure. They don't care about the mood. They care about the mechanics. The crisis elements you listed, weak yen, low rates relative to the U.S., are literally the fuel for the profit engine.
So the bad news is the good news, provided you have the right machine to process it.
Precisely. Let's go back to that prism metaphor. The source material splits this event into 4 layers. If we walk through them, you'll see how the crisis morphs into profit, depending on your position.
Let's do it. Layer 1, the currency layer, the yen.
Okay, so imagine you're a regular person living in Osaka. You run a small bakery. You need to import wheat, butter, maybe some specialized machinery from Germany or the U.S.
And I'm paying for all of that with yen that I earn from selling croissants to locals.
Correct. And suddenly your yen buys 30% less wheat than it did 2 years ago. Your costs just exploded. You can't raise prices fast enough to cover it because your customers' wages haven't gone up, so your margin is dead. From this observation position, a weak yen is a disaster. It's a theft of your purchasing power.
Right. My grocery bill is up, my gas bill is up, I'm miserable. That's the Forbes narrative. Japan is crumbling.
Now switch positions. Teleport yourself. You are now the CEO of one of these Sogo Shosha, let's say Mitsui or Mitsubishi. You're a global conglomerate. You sell energy, metals, machinery, food, all over the world. You get paid in US dollars, euros, pounds.
Okay, so my revenue bucket is full of foreign currency. I'm swimming in dollars.
But your headquarters is in Tokyo. You report your earnings in yen. So when you bring those dollars back home to report your quarterly profit, what happens?
The weak yen acts like a multiplier. I get more yen for every single dollar I bring home.
Exactly. It's an automatic accounting windfall. You didn't sell more product. You didn't become more efficient. But your reported profits just jumped 20% simply because the currency denominator slid. So for the bakery owner, weak yen equals crisis. For the Sogo Shosha and its shareholder, Mr. Bucket weak yen equals record profits.
It's the exact same event. It's just a matter of which side of the transaction you're on. Are you buying imports or selling exports?
Spot on. The event is neutral. The position determines the polarity. Now let's look at layer 2, the interest rate layer. This is where it gets a bit more technical, but it's crucial. That Forbes video was screaming about rising yields.
Right, the whole debt spiral fear.
And that fear is real. If you're the system administrator, if you're the Japanese government, rising rates are a nightmare because you have to refinance your debt constantly. It eats up your tax revenue just to pay interest. That creates instability. It shakes the foundation of the state.
But Buffett isn't the government.
No. And remember what we said about his debt. He issued those bonds years ago, or at least before the most recent spikes. And he locked in fixed rates.
So the government is dealing with the floating reality of today's market, but Buffett is shielded by a contract he signed yesterday.
It's called asymmetry. The impact of interest rates isn't uniform. It depends on when you enter the market. The crisis of rising rates hurts anyone who needs to borrow today, like a young couple trying to get a mortgage in Tokyo. They're facing a crisis. But for the giant who secured cheap capital yesterday, the chaos in the market actually helps.
Helps. How does the chaos help?
Because it keeps the competition down. High rates raise the barrier to entry. If you have a war chest of cheap money and your competitors have to borrow expensive money, you win by default. Buffett is essentially watching the chaos from a VIP box seat that he paid for 3 years ago.
That's dark.
Yeah.
But it makes sense. The barrier to entry just got higher for everyone else, protecting the incumbents. Okay, let's talk about layer 3, the business structure itself. You mentioned Sogo Shosha. Why these specific companies? Why didn't he buy, I don't know, Sony or Toyota?
This is really interesting because Sogo Shosha are unique to Japan. We don't really have a direct equivalent in the U.S. They aren't just one business. They are multi-layered conglomerates that handle everything: logistics, mining, food, retail, finance, consulting.
They sound like mini economies.
That's a great way to put it. They are mini economies. The source material highlights their structural resistance to instability. Because they own the supply chain, from the mine in Australia to the convenience store in Tokyo, they capture value at every step. If raw material prices go up, their mining division wins. If prices go down, their manufacturing division wins because costs are lower.
They're hedged by design.
Yes, and Buffett loves that. He understands that structure because Berkshire is built the same way. So when Forbes says Japan is volatile, Buffett looks at the Sogo Shosha and says, these specific shifts are built to sail in rough water. He isn't betting on the calm. He's betting on the boat.
I like that distinction, betting on the boat, not the weather.
Yeah.
But there has to be a catch. You can't just print money forever using this arbitrage. Eventually something breaks, right? Which brings us to layer 4, time.
The important layer, according to our notes, and this is where the optimism has to be tempered with reality. The Forbes commentary and the Buffett success are both valid right now. But if you stretch the timeline, things get murky. Well, think about the mechanics we just discussed. A weak yen destroys local purchasing power. Rising rates squeeze the government budget. If you run that simulation for, say, 10 years, the system cracks. You get social unrest, or a sovereign debt default, or hyperinflation where the money becomes worthless.
And if the system cracks, the Sogo Shosha, no matter how strong they are, eventually have no market to operate in.
Exactly. The source warns about a hidden risk. The success signal is only valid for this specific slice of time. It's like surfing a massive wave. In the moment, you're moving fast, it's exhilarating, and you look like a genius. But structurally, a wave is just water that is about to crash.
So Buffett is surfing, but he knows the wave eventually hits the beach.
And he's betting he can get off the board before it does, or that the wave will last just long enough for him to cash out his dividends. But for the country of Japan, they are the ocean. They can't just get off the board. They have to deal with the crash.
That is a sobering thought. So we've split the light. We see that crisis and profit are just two different cross-sections of the same complex machine. This leads us to the synthesis part of the notes, the mini-fields approach. It talks about the narrative layer versus the OS layer.
This is my favorite takeaway from this research. We, the public, the voters, the news consumers, we live in the narrative layer. We consume stories. Japan is doomed. The U.S. is booming. Crypto is the future. These are vibe checks. They're emotional.
It's how we feel about the economy at the dinner table.
Exactly. But the OS layer, the operating system, is where the actual mechanics happen. Interest rate differentials, currency spreads, dividend yields, corporate structure.
And the realization here is that the people making the money are ignoring the narrative and hacking the operating system.
100%. Well, the news is screaming about the crisis of the weak yen. The OS players are quietly looking at the math and saying, I can borrow yen at 1%, convert it to assets earning 5%, and hedge the currency risk. They aren't worried about whether the story is sad. They're looking for structural gaps in the code.
It explains why there is such a disconnect between the economy, the stock market, and the economy, how people actually feel.
Yes, the stock market is often a reflection of the OS layer, how efficiently capital is extracting value. The real economy is the narrative layer, how easy or hard it is for a human to survive. In Japan right now, those two things are moving in opposite directions. The OS is generating profit, while the narrative is generating pain.
Which brings us to the final point. The source material had this silent note at the end of the ECP-5 framework. It wasn't about math, it was about access. And I think this is where we really need to land the plane.
This is the sting in the tail. We've spent this whole time explaining how this profit machine works. It's clever, it's legal, it's structural. But the lingering question is, who's allowed to turn it on?
Right. Can I do it? Can the bakery owner in Osaka do it? Can he issue yen bonds to hedge his wheat costs?
No. And that's the point. The crisis, part inflation, expensive imports, the government squeezing services, That is democratized. Everyone participates in the crisis. You can't opt out of paying more for bread. You can't opt out of your taxes going up.
But pain is universal.
But the profit structure, the ability to borrow billions of yen at near zero rates and buy global equities, that is a VIP club. That requires massive balance sheet access, credit ratings, institutional relationships.
So the crisis is distributed to the public, but the profit mechanism is gated for the elite capital.
Exactly. The source suggests that the real divide in the modern economy isn't just rich versus poor in terms of a bank balance. It's a divide in observation position. Some people are forced to live in the narrative layer, suffering the consequences of the macro environment. Others have the keys to the OS layer, where they can actually engineer an outcome that profits from that same volatility.
That fundamentally changes how I view wealth inequality. It's not just having more chips, it's playing a different game entirely.
It's sitting in the dealer's booth while everyone else is at the slot machines.
Wow. Okay, for all of you listening, I think we need to let that marinate. The next time you see a headline that says market in crisis, don't just ask, is it bad? Ask the deeper questions. Bad for whom? Good for whom? And who has the access to turn this volatility into an asset?
And maybe check if Warren Buffett is buying or selling. That's usually a good cheat sheet.
Always a good heuristic. That's it for this deep dive into the Japan paradox. We hope this PRISM framework helps you decode the next financial freakout a little better. Thanks for listening, and we'll catch you on the next one.